Using the DST with a 1031 exchange. Today on Blueprints for Prosperity.
Sitting here with Eric Scaff and Peter Fisher, real estate experts in the real estate industry. Let's sit here to talk about passive investments in real estate. You guys want to tell me about the DST?
The DST, known as the Delaware Statutory Trust, it's a multiple owner structure, so it actually allows for many investors to come in. They share an ownership of large, institutional, professionally managed properties. So these properties are typically occupied, they're stabilized, and they're paying consistent income to our clients, often used for 1031 tax-deferred exchanges. The DST goes back to a revenue ruling in 2004 that allows it to be considered a like-kind property for 1031 tax-deferred exchanges.
Interesting.
So for all the people that are in love owning real estate but are tired of doing the work and they're looking for something passive, not only has the IRS approved this, but it's a good opportunity to consider for your replacement property.
Yeah, it's funny you mentioned that. Why would an investor choose the DST over other real estate investments?
Well, this starts with a real basic question. When we're talking to clients, it's typically what is your goal? What is it that you are looking for? And when doing 1031 exchanges, Eric, what's the reason why we do 1031s?
Well, because you get to defer your taxes, so any capital gains tax that you would typically have a liability for, you can defer through the 1031 exchange.
Right.
And so this is a great opportunity. It's, in my mind, one of the best laws in the tax code for growth of your wealth.
This is an interesting question. So I asked you, why do we do 1031s? And you responded to defer tax. And that's typically not the reason why we see our clients utilizing the DST. And when I ask them, what are your goals? What are you looking to do here? One of the biggest reasons is typically to get out of property management. So the DST, being that passive real estate investment strategy, allows for our clients to get away from that day-to-day management of the real estate that they hold. And I mean, it goes beyond that, right? Estate planning, leftover, backup on identifications, and we can get into some of this. I know it gets a little more complicated.
Yeah, you say the assets are more passively managed. Who is doing the management there?
The entity known as a sponsor. So in the industry, we call them sponsors. These are typically very large real estate groups that operate across the country, typically operating multi-billions of dollars of real estate for their investors.
What types of properties are typically included in the DST?
It's all types. Really, we have things that are in all asset classes. Typically, the normal food groups, as they say, would be multifamily, industrial. Could be retail, could be office, but we also see some specialty opportunities for things like self-storage or student housing.
And they're institutional size, right? So is there like an equity raise that you typically see? Is there a range there?
A typical property that I always like to explain is at least today, in today's environment, we look a lot at multifamily. When our clients come to us, it's usually the first asset class that we start talking about, based on the demographics of our population currently. So a typical institutional multifamily property is going to have 200, 300 to 400 units, and these are going to be $100 to $200 million assets. It really does depend on the quality of the property and where it's located. So these equity raises that you ask about, they can be anywhere between 100 to 200 million, depending on the leverage.
These properties are located all across the U.S.?
So typically in areas where you're going to see population growth and job growth, and where we're seeing the more demand for property. So we're typically finding in a DST, these deals would be 1 or 2 years old, brand new, Class A type assets.
Now, this may be a dumb question, but do these properties, are they located outside the U.S. at any point?
No. In fact, based on 1031 regulation, you cannot do a 1031 exchange across country borders, I guess is the way I'll put it. So if you're doing a 1031, it has to be inside the United States or it has to be outside the United States.
Okay.
The sponsors that we work with, while they may have international assets, they typically don't offer those through a DST.
Okay, and can you exchange from an international property into a United States property?
No.
You can't.
Okay. And with all investments, there's obviously risk involved. Can you guys touch on the risk associated with these investments?
Sure. Yeah. We look at risk, and if we're talking about a DST in particular, sponsor risk is probably one of our first considerations that we go through. So, what is sponsor risk? Well, this is the company that is physically going out there and buying the real estate on your behalf. They're financing the real estate and they're managing that property for you. So if that sponsor doesn't have experience, if they don't have deep pockets, we may not even work with them until we know that they have a certain amount of experience. They've gone full cycle on deals. We want to know who they are before we put any money with their funds.
Yeah, and one of the great things about our industry here is that it's a small enough group of companies that we get to know them very, very well. And so we have had relationships with many of these sponsors for over 10 years. Peter formerly worked at one of the sponsors for probably one of the biggest ones in the market. And we really are focused on their long-term track record and basically how many assets they have under management.
So, we're going to list through all the risks, right? Mm-hmm. So sponsor risk, real estate risk, operational risk, and we talk about fees. Yeah. Like I don't see fees as a risk, but it's something that we need our clients to understand that these programs, the DST or any real estate fund that you get into, there's always fees associated with it. So you need to understand what those fees are.
And what does it kind of look like in the economic downturn if we're heading in towards a recession with real estate prices falling? Do the sponsors step in to kind of help with that in any way, or?
So if you're talking about an existing program that's been operating for several years, and there may be a major macroeconomic downtrend, typically the sponsor is going to be managing through that. You could have volatility in your monthly income. And we are thinking about all of these assets as long-term assets. So there may be some short-term pain in anything that you invest in, but again, they're managing it for the long-term, for long-term value to preserve your capital and generate income.
Well, and this is where it comes down to, who you work with and acquiring the right real estate. Right? So if we're in today's economy, we're doing an analysis on the secondary markets that we're in, and we're looking at population growth, we're looking at job growth, and most importantly today is there's a shortage of housing, whether it's on the multifamily side or whether it's on the single family side. So we want to be in that space where we have flexibility. We know that there are going to be renters. Eric, and we can talk more about triple net leases, and we can pick on dollar stores and Walgreens and where are they going to be in the next 5 to 10 years? It's questionable. Yeah. So we feel comfortable going into a space where we know the population is demanding housing. So we do like multifamily today, as well as other assets, but we do spend a lot of time talking about multifamily.
And I would just add that when you think about the downturn in the economy, you really want to be in the highest quality asset that you could be in to deal with that fact that the market as a whole is going down. So when we're having the upfront discussions with our clients and we're talking about the various options that they could go into, we really want to encourage them not to just focus on the first year stated income that they would be generating, because number one, there's no guarantees. Number two, the one that has the highest income in the first year may not be the best asset that you're going to have long term that will be able to handle changes in the economy. So this is one of the tips that I think everyone in the market, that anyone that would ever buy a DST should be thinking about.
And you mentioned a bit earlier that the DST is a long-term investment. Do these DSTs, they have liquidity features involved with them?
Most of them do not. There are certain types that do if they roll into through a second transaction through a 721, which we can get into later. But most of them are considered all liquid. And even though you own your interest and you have the ability to sell it, if you're going to sell it in the market outside of the sort of natural process, you're going to be taking a discount. So we typically would want to encourage you not to go into a deal that you think you may have to get out before the natural exit.
And Peter, you mentioned triple nets. Can you go into how these kind of compare with those?
Sure. What is a triple net? First of all, it's an entity. We think about Walgreens, where the tenant's actually paying the taxes, the maintenance, and the insurance. So it relieves the landlord of that responsibility. It seems like a very attractive feature, right, for a landlord or for an investor. They're typically long-term leases, so they're 20 years is a typical. Let's just pick on Walgreens a little bit. 20 years is a typical lease with Walgreens, and you're locked into those leases. So as an investor, you say that's great. I get income for 20 years. I don't have to worry about anything.
Totally passive.
Totally passive. Sure. But when Walgreens leaves that space, then you have zero value left in the real estate. And it typically goes to a special servicer where your income is likely going to go away as well. So the DST can actually structure their real estate with triple net leases, but there's also a master tenant that backs that up, who is typically the sponsor. So the sponsor is taking a lot of liability there to ensure that that program is operational and their obligations can be paid. So if triple net leases are something that our clients are interested in, we have the ability to place them into a DST with a triple net lease. But in my opinion, in this environment that we're in today, I would prefer to have adjustable leases with multiple tenants. I don't want one tenant. We talk about real estate risk. What's the biggest risk in real estate, Eric?
The tenant.
The tenant. If you don't have a tenant, you don't have income. If you don't have income, you can't pay your obligations. So we focus a lot on who the tenant is. And again, we can look at self-storage, we can look at multifamily. If we want a single tenant triple net, we're probably gonna look at industrial assets. Last mile distribution centers like an Amazon facility. We feel a lot more comfortable with that than going into a retail asset in today's environment.
And a big part of investments is diversification. How does diversification factor into the DST?
Well, I think one of the great things about the Delaware Statutory Trust is you can pick your allocation amount. So if you have $1 million exchange, instead of going into one property on your own that you go with that $1 million, you can take the same proceeds and use that in multiple DST programs. So you can either go into a DST that has multiple assets in it, or you can go into multiple DSTs. And so typically, depending on our clients' net worth and liquidity needs and things of that nature, we would be recommending somewhere between 2 to 4 DSTs for a $1 million trade.
There is sort of a guideline that we've had internally. We don't talk a lot about it, but we do try to keep each DST within about 10% of our clients' overall investment portfolio. So, again, if you have that $1 million transaction, unfortunately or fortunately, I've done 10 different deals with clients, $100,000 in each one, to create that diversified portfolio and protect the downside risk. Because, again, it's real estate. We talk about the risks of owning real estate. Things can go wrong, but if you have 10 deals versus one, obviously, we understand that risk is being reduced.
So I'm an investor, I'm a potential client. I've sold my rental property for $1 million. I'm looking at doing a private deal, but I still have some money left over. Am I able to allocate that additional portion towards a DST?
Yes. Yeah. So this is pretty typical. Clients will come to us with the intent of purchasing real estate on their own through a 1031 exchange. And the DST can be a supplement to purchasing private real estate or fee simple real estate on your own. So the DST can actually just go into that mix, right? You're creating that diversification. It's not uncommon for us to work with clients on multiple different strategies through 1031 exchanges.
And that leftover piece that would be normally called the boot, the dreaded boot, can be taken care of through the Delaware Statutory Trust as a small piece.
And I know you do have to replace debt on 1031 exchanges. Does DST provide that replacement debt for you, or do you have to go get your own loan? How does that work?
So the DST, it's an interesting structure because the sponsor, right, that we talked about earlier, is physically buying the property with their own capital. It's going on their balance sheet, so it's their responsibility. They're also securing financing through traditional lenders in most cases. 5, 7 to 10 year terms on the loans. And those loans in today's environment are anywhere between 30 to 50% loan to value. It's non-recourse financing. So that means as an individual, if you're investing in the DST, you do not have to go through underwriting with the bank. It is not on your balance sheet. You do not have to service the loan. You have no responsibility or liability for that debt because it's at the trust level, it's at the DST level. So yes, to answer your question easier, DST comes with debt. So when we're executing 1031s, as you know, you need to replace the full property value. And that can include financing that was on your relinquished property. So the DSTs solve that solution. We provide debt to individuals that's non-recourse.
Sounds like a pretty easy transaction here.
This is, I've been in real estate for about 35 years, and I will tell you that since all the work is done before the investor gets to it, it's one of the easiest transactions out there.
And what is a typical closing timeline? Say I'm running close on my 180th day or 45-day ID deadline. How quickly could you guys get me into one of these investments?
Yeah, I would say typically your expectation should be about 5 days, but it can be as quickly as you need it to be done. And because the property has already been purchased and it's already fully packaged for you as an investor, there's just a process that needs to go through between the qualified intermediary and the broker dealer and the sponsor. And that usually takes a couple of days, but it is very, very easy transaction.
Well, this has been really interesting. Thank you guys for joining me and talking about the DST. Anything else you guys want to add before we wrap up?
I appreciate your time today, Ben.
Thanks, Peter.
Thanks.
Thanks, Eric.